A 62-year-old engineer retires with $2.3 million, does everything the financial planner says: diversified portfolio, 4% withdrawal rule, 12 months of expenses in cash. 7 years later, he's back at Home Depot wearing an orange apron. Not because the market crashed, not because he bought a yacht, he just ran the numbers wrong. A couple buys a retirement home in Florida at 59, paid cash, no mortgage. They're living the dream, right? At 74, they're selling it at a loss, moving into their daughter's basement. What happened? They calculated everything except the one thing that mattered. Here's another one. A woman retires at 60 with $1 million in her 401k. Feels rich. 10 years later, she's taking $27,000 in required minimum distributions, paying taxes on 85% of her Social Security, and her effective tax rate is higher than when she was working. How does that even happen? I'm going to walk through 5 structural problems that silently destroy retirement plans, and I'm not talking about overspending or market crashes. I'm talking about systemic issues baked into the retirement system itself that nobody explains until it's too late. These aren't behavioral failures. They're design flaws in how retirement actually works versus how we're told it works. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report so I don't store any of your financial data. Link in the description. Think of retirement as a bridge. You're standing on one side with your working income, and you need to cross to the other side where your investment income lives. The bridge looks solid. Financial advisors measured it. They gave you a number. But here's what nobody tells you. That bridge has weight limits that aren't posted anywhere. And the weight isn't your spending. It's time, it's sequence, it's the order in which things happen to you. You can do everything right and still watch the bridge buckle because you didn't know about the hidden load-bearing calculations. Let me start with the first thing that quietly ruins retirement, and it's not healthcare costs. It's healthcare cost sequencing. Everyone knows healthcare is expensive. That's not the secret. The secret is when the expense hits relative to market performance, and nobody talks about this. There's this concept in finance called sequence of returns risk. If the market drops 25% in your first 3 years of retirement, you're toast, even if it recovers later. Because you're selling shares at depressed prices to fund living expenses, you lock in losses and you never recover the compounding you would have had. Now, here's where it gets really interesting. Healthcare costs do the exact same thing, but worse. Let's say you retire at 63. You're on COBRA for 18 months, then you're buying insurance on the ACA marketplace until you hit 65 and Medicare kicks in. You calculated this. You budgeted $1,800 a month for premiums. Fine. But what you didn't calculate is that at 64, you have a cardiac event. Nothing catastrophic. Stents, recovery, but your out-of-pocket maximum gets hit. That's $9,000 you weren't planning to pull from your portfolio that year. Now you're withdrawing an extra $9,000 from investments that are down 12% because the market's having a bad year. You just sold shares at a loss to cover a medical event. That's a permanent loss of capital. Those shares will never recover for you because they're gone. But now you might think, okay, that's just bad luck. 1 year, you recover. Except Medicare isn't free. Medicare Part B costs $174.70 a month for most people in 2026. Part D, for prescriptions, another $30 to $60. Medigap, to cover what Medicare doesn't, another $150 to $300. You're at $4,000 to $5,000 a year minimum. And here's the kicker. Medicare Part B and Part D premiums are income-based. They look at your modified adjusted gross income from 2 years ago. If you had a good income year, or if you did a Roth conversion, or if you sold a property, your Medicare premiums can jump to $244.60, $349.40, or even $454.20 a month for Part B alone. That's an extra $3,000 to $4,000 a year in premiums because of income you earned 2 years prior. Nobody tells you this. The financial plan says healthcare costs, and you think it's a fixed number. It's not. It's a variable cost tied to your income with a 2-year lag, and it can spike exactly when you don't need it to. I know a guy, ran a small manufacturing business for 30 years, sold it at 64 for $1.8 million. Great exit. He thought he was set. The sale pushed his income over $206,000 that year. 2 years later, his Medicare Part B premium was $454.20 a month, and his Part D premium was $81.90 a month. He went from expecting $2,000 a year in Medicare cost to over $6,000 for 1 year because of a tax rule he didn't know existed. And that extra $4,000 came out of his portfolio during a year when the S&P was down 18%. Sequence matters. The second thing that quietly destroys retirement is something called the tax torpedo. And I promise you, your financial advisor either doesn't understand this or didn't explain it. Here's how it works. You spend your career putting money into a 401k. Pre-tax, you get the deduction, you defer the taxes, the account grows. You retire with, let's say, $1.2 million in tax-deferred accounts. You're thinking, great, I'll just pull out what I need and pay ordinary income tax. Reasonable, right? Wrong. At 73, required minimum distributions kick in. The IRS forces you to withdraw a percentage of your tax-deferred accounts, whether you need the money or not. At 73, it's about 3.8%. At 75, it's 4.1%. At 80, it's 5.3%. So at 73, you're pulling out $45,000 from your $1.2 million 401k. You don't need it, but the government says you have to take it, and it's taxable income. Now let's add Social Security. Let's say you're getting $30,000 a year from Social Security. You think Social Security isn't taxed, right? Wrong again. Social Security benefits are taxed based on your combined income. Combined income is your adjusted gross income plus half of your Social Security benefits plus any tax-exempt interest. If your combined income is over $34,000 as a single person or $44,000 as a married couple, up to 85% of your Social Security is taxable. So you take your $45,000 RMD, add half of your $30,000 Social Security, that's $15,000, and your combined income is $60,000. That means 85% of your $30,000 Social Security, which is $25,500, is now taxable income. Your total taxable income is $45,000 from the RMD plus $25,500 from Social Security. That's $70,500. You're now in the 22% federal bracket, and depending on your state, you're paying another 4 to 6%. Your effective tax rate on that RMD just hit 28%. You worked your whole life deferring taxes, and now you're paying a higher rate in retirement than you did while working. But here's where it really gets absurd. Let's say you want to pull an extra $20,000 from your 401k to replace your car. That extra $20,000 pushes more of your Social Security into taxable territory. You're not just paying 22% on the $20,000. You're paying tax on the portion of Social Security that just became taxable because you crossed the threshold. The effective marginal rate on that extra $20,000 can hit 40 to 45% when you include the Social Security taxation. I've seen this personally. A friend of mine, retired at 67, wanted to withdraw $30,000 to redo his kitchen. The tax bill on that $30,000 was $13,500. He thought he'd pay 22%, maybe $6,600. He paid more than double because of how it cascaded into Social Security taxation. The system is designed to punish you for accessing your own money. And nobody explains this until you're sitting in front of a CPA in April, writing a check to the IRS, wondering how you got ambushed. The third thing, and this one is pure psychology, is lifestyle lock-in. Everyone talks about lifestyle creep during your earning years. You make more, you spend more. But nobody talks about lifestyle rigidity in retirement. Here's the problem. When you retire, your income drops, sometimes by 30 to 50%. You go from $80,000 a year to $45,000 in combined Social Security and pension, and you're pulling another $30,000 from your portfolio. So you're at $75,000 now instead of $80,000. Not a huge cut, manageable, right? Except you can't cut expenses proportionally because most of your costs are fixed. Your mortgage or rent doesn't drop, your property taxes don't drop, your car payment doesn't drop, your insurance doesn't drop. So you're stuck with the same expense base on a lower income, and the only discretionary spending left to cut is the stuff that makes retirement enjoyable. travel, dining out, hobbies. There's a concept in corporate finance called operating leverage. When revenue drops, companies with high fixed costs get crushed because they can't reduce expenses fast enough. Retirement is the same. You have high operating leverage. Most of your budget is fixed, and when your income drops, you don't have the flexibility to adjust without sacrificing quality of life. I watched this happen to a couple who retired at 61. They had $1,700 a month in fixed costs: mortgage, property tax, insurance, utilities, car payment. Their combined Social Security was $3,200 a month. That left them with $1,500 for everything else: food, gas, entertainment, medical copays, car maintenance. They thought they'd travel. They thought they'd golf. They ended up sitting at home watching TV because there was no room in the budget. They weren't broke. They had $400,000 invested. But they were psychologically locked into a scarcity mindset because their cash flow was so tight. The bridge didn't collapse. It just became a bridge to nowhere. And here's the thing. They couldn't downsize easily. The house was paid down, but not paid off. Selling meant realtor fees, moving costs, and buying something smaller in the same area wouldn't have saved much because housing prices had risen. They were trapped in a lifestyle they could no longer afford, but couldn't escape without taking a major financial hit. This is what I mean by systemic design flaws. The retirement system assumes you can scale your lifestyle seamlessly. You can't. Expenses are sticky. And the delta between working income and retirement income is where dreams go to die. The fourth thing is hidden family obligations, and this one sneaks up on everyone. The financial plan assumes you're only funding your own retirement, but in reality, you're funding multiple generations. There's a term for this: the sandwich generation. You're squeezed between aging parents who need financial or caregiving support and adult children who aren't financially independent yet. Let me tell you a story. A guy retires at 64, solid plan, $750,000 in investments, pension of $2,000 a month, Social Security of $2,400 a month. He's budgeted for himself and his wife. 2 years later, his 87-year-old mother falls, hip fracture. She needs full-time care. Medicare covers some of it, but not the ongoing assistance. Assisted living in his area is $4,500 a month. His mom has $1,200 a month in Social Security. That's a shortfall of $3,300 a month, or $39,600 a year. He's now funding that gap. His retirement plan just took a $40,000 annual haircut that will last for an unknown number of years. But wait, there's more. His 31-year-old son loses his job. Tech layoffs. The son has 2 kids, and he's 3 months behind on rent. Can he move in for a while? Sure. A while turns into 14 months. The retiree is now covering an extra $600 a month in groceries, an extra $150 in utilities, plus he lent his son $5,000 to cover the rent gap. That's another $9,000 a year, and the $5,000 loan is never coming back. In 2 years, this guy went from a comfortable retirement to pulling an extra $50,000 a year from his portfolio to cover family obligations that weren't in any financial plan. His withdrawal rate went from 4% to over 10%. At that rate, he's running out of money in 12 years. This isn't a failure of planning, it's a failure of assumptions. The retirement calculators don't have a field for probability your parents need financial support or likelihood your adult children boomerang home. But the probability isn't zero, it's high. According to Pew Research, in 2023, 57% of people aged 45 to 64 are providing financial support to both adult children and aging parents. 57%. That's not an edge case, that's the base case, and nobody builds it into the model. The fifth thing, and this is the one that gets philosophical, is longevity risk meets purpose risk. Everyone talks about longevity risk as running out of money. You live to 95, and your portfolio only funded to 85. That's a real risk. But there's another kind of longevity risk nobody mentions. Running out of purpose before you run out of money. You retire at 62, you're healthy, you're active, you've got 30 years ahead of you, maybe more. The first 2 years are great. You travel, you golf, you do all the things you didn't have time for. Then year 3 hits, and you wake up one day and think, now what? You've done the trips, you've played the courses, you've read the books, and you realize you have 27 more years of what? Exactly. This is where retirement falls apart psychologically. And when the psychology breaks, the finances follow. People without purpose spend money to fill the void. They buy things. They take more trips that aren't satisfying. They develop expensive hobbies they don't stick with. Or worse, they become financially paralyzed. They stop spending altogether because they don't know what they're spending for. I've seen people with $2 million live like they have $200,000 because they've lost the plot. They don't know what the money is for anymore. Retirement wasn't supposed to feel like this. It was supposed to feel like freedom. Instead, it feels like a really long weekend with no plan. There's a concept in behavioral economics called hedonic adaptation. We adapt to positive changes and return to a baseline level of happiness. That new car thrill lasts 3 months. The retirement honeymoon lasts maybe 2 years. After that, you adapt and you're back to baseline. If you don't have something pulling you forward, something bigger than leisure, you're just existing with a portfolio. And that's when people make catastrophic financial decisions. They go back to work not because they need the money, but because they need the structure. Or they don't go back to work and they sink into low-grade depression. And that leads to health problems, which circles back to healthcare cost sequencing, and the whole thing spirals. Let me give you a real scenario to tie this together. Meet Tom. Not his real name, but the numbers are real because I've seen this exact pattern 3 times. Tom retires at 63 with $1.4 million in his 401k, $200,000 in a brokerage account, and a paid-off house worth $450,000. He's got Social Security of $2,600 a month starting at 65. His wife has Social Security of $1,800. Combined, that's $52,800 a year. They figure they need $80,000 a year to live comfortably. That's a gap of $27,200 they'll pull from the portfolio. At a 4% withdrawal rate on $1.4 million, they can pull $56,000 a year safely. They've got cushion. Year 1, everything is fine. Year 2, Tom's dad dies. His mom needs help. She moves in with them, but she has medical needs. They spend $12,000 that year on her care that insurance doesn't cover. Year 3, Tom has a health scare. Not serious, but scary enough that he wants to do all the things he's been putting off. They take a big trip to Europe, spend $18,000. Worth it, they say. Year 4, their daughter loses her job. She moves back home with their 2 grandkids. Tom and his wife are covering another $800 a month in expenses. Year 5, required minimum distributions kick in at 73 for Tom. He has to pull $53,000 from his 401k. Combined with Social Security, his income is now over $100,000. His Medicare Part B premium jumps to $244.60 a month. His tax bill is $14,000 higher than expected because of the RMD and Social Security taxation interaction. Year 6, his portfolio is down 18% because the market corrected. He's still pulling out the $53,000 RMD plus another $15,000 for living expenses. He's selling shares at a loss. Year 7, he's 69 years old. His portfolio is down to $900,000. He's burned through $500,000 in 6 years. At this rate, he's broke by 80. He doesn't want to go back to work, but he's starting to think he might have to. What happened? He didn't buy a boat. He didn't gamble. He got hit by healthcare sequencing, tax torpedoes, family obligations, and a market downturn all in a compressed window. The bridge had hidden weight limits, and he found every single one. Now you're asking yourself, what do I actually do about this? Here are 3 things that aren't generic nonsense. First, model your retirement in tax layers, not total assets. Stop thinking about your net worth as one number. You have tax-deferred money, taxed at cap gains money, and tax-free money if you have a Roth. The order you pull from these accounts matters more than the total balance. If you're going to retire before 73, do Roth conversions in the gap years before RMDs start. Pay tax at 12 or 22% now to avoid paying 24 or 32% later when RMDs and Social Security stack. This isn't theoretical. This is the difference between a sustainable plan and a tax disaster. Second, stress test for healthcare cost spikes in down markets. Run a Monte Carlo simulation, but add a healthcare shock in year 2 or 3 of a bear market. See what happens to your portfolio when you're pulling an extra $15,000 in a year when your accounts are down 20%. If the plan breaks, you don't have enough cushion. You either need to work longer, save more, or plan to reduce spending in down years, which most people can't do because of lifestyle lock-in. Third, build purpose into the plan before you retire. I'm serious. If you don't know what you're retiring to, don't retire yet. The people I know who have successful retirements aren't the ones with the most money. They're the ones who replace their work identity with something else that gives them structure and meaning. Volunteer work, part-time consulting, teaching, building something. It doesn't have to be paid. It has to matter. Because if it doesn't matter, you're just running out the clock, and that's when the financial plan falls apart. Here's the reality. Retirement is a financial engineering problem wrapped in a psychological minefield, buried in a tax code designed to extract maximum revenue at the worst possible time. The system isn't built to help you. It's built to look like it helps you while actually creating trapdoors you won't see until you step on them. The couples who make it aren't smarter. They just saw the trapdoors earlier. Don't work for money. Own the companies that do. And when you retire, make sure you know what you're actually retiring into, because the bridge only holds if you know where the weight limits are.